it's just been such a wild ride. In fact, that late stage reversal when it comes to US markets was really something to see. What does that tell you about volatility potentially being here to stay? How long does this kind of play out for, or do you position for, given that it feels like markets see this as almost a short-term thing?
Yeah, I think in the near term it's going to be really, really tricky because you have the Russia-Ukraine crisis happening right now, and in the not so distant future, you have the first rate hike for this year. So the markets will probably have to vacillate between the Russian-Ukraine crisis and the potential first hike in about 3 to 4 weeks' time. What you could possibly do is you need to actually maintain your portfolios in a pretty diversified manner, so that you do not get caught in any one risk event and see your portfolios being sold off sharply. And I think the best way to actually hedge against this current situation is to basically be overweight on commodities, because of the fact that commodities has actually run up quite a bit, but still it will remain in sharp focus and likely to be able to actually give us positive returns in light of what's happening with the Russia-Ukraine situation.
How do you get exposure though via that commodities edge?
Well, you can actually get exposure via oil, via gas, and as well as some of the agricultural commodities as well. Because don't forget that Russia is actually one of the biggest, or if not the biggest, producer of wheat. And of course, Ukraine is not a small commodities producer in any measure as well. So if you get exposure to the commodities index in that sense, you can perhaps hedge against some of the volatility risk that's actually happening with the Russia-Ukraine crisis. But do bear in mind that geopolitics, where on a longer term basis, and that's talking about 3 months and above, usually do not have a negative impact on capital markets.
On the flip side, given the rise in commodities prices, especially in oil, where do you see the biggest impact on all of these different assets across Asia, given that we are expecting profit margins to get pressured as well?
Yeah, I think if you look at Asia ex Japan, the leading net importer of oil will likely actually be adversely affected if oil prices do not correct and if oil prices remain above $100 for a prolonged period of time. And in this group, you have countries like, for example, Thailand, India, and to a certain extent, Indonesia and the Philippines as well. If oil prices continue to run where they are, then I think Thailand is probably the most vulnerable because of the fact that they are the biggest net importer of refined oil in this region. Indonesia, to a certain extent, benefits because of the fact that crude palm oil prices have actually run up as well, and likewise gas. But if oil prices remain indefinitely high, then obviously the current account will also be adversely affected by that.
Kelvin, how do you feel about the semiconductor space across Asia? We saw chip makers really under pressure yesterday, for example, given that some of the materials were sourced from Ukraine. Not to mention that now we're hearing from Fumio Kishida that Japan will impose controls on semiconductors in this US-led move.
Yeah, that's likely to actually adversely affect some of the semiconductor makers on a short-term basis. The problem with that is that we don't know how long this conflict is going to last, right? And if they impose sanctions on an indefinite period of time, some of these semiconductor makers will probably have to actually bear in mind that their margins could be affected by the fact that they can't actually supply what is actually needed to the market right now. And on top of that, that will also have a snowballing effect on the car automakers, on some of the other computer makers as well, because of the fact that demand for electric vehicles, demand for consumer electronic goods remains very, very high. So that could actually affect some of the electronic makers further down the road.
We have heard with all of this volatility calls that perhaps we should be increasing exposure to China, given that they are sort of trading like safe havens, especially with the Chinese yuan. Mark Mobius talking about how China is really bound to grow. What do you make of those comments? Can China actually act as a hedge?
Yeah, I think to a large extent it can, largely because of the fact that valuations in China are very, very attractive. The market is basically trading at about 12 times 12 months forward earnings right now. And on top of that, the yuan has actually been really strong, given the fact that China's exports remain at near all-time highs, and therefore the current account surplus has been very, very well supported. Now, if you look at the Chinese yuan, it's actually gained by about 14% against the US dollar on trade-weighted basis over the last 12 to 14 months. That in turn basically means that inflation is not really a serious concern in China as it is in some of the other G10 economies. And for that measure, China can actually afford to cut rates further, ease further, and in that sense, it is likely to actually be able to do better than some of the other G10 economies, which are getting squeezed from lower growth and at the same time with high inflationary pressure, leading in turn to basically higher interest rates.